This video will focus on accounting for notes receivable. Companies may grant credit in exchange for a formal credit instrument known as a promissory note. This gives the holder a stronger legal claim to assets than do accounts receivable. A promissory note is a written promise to pay a specified amount of money on demand or at a definite time. Promissory notes may be used when individuals and companies lend or borrow money, when the amount of the transaction and/or the credit period exceed normal limits, and lastly, in settlement of accounts receivable for customers who need to extend the payment. The majority of notes, however, originate from lending transactions. The basic issues in accounting for notes receivable are the same as those for accounts receivable: recognizing notes receivable, valuing notes receivable, and then finally disposing of notes receivable. We will address these issues, but before we do, we need to compute interest. The formula for computing interest is PRT, or principal times rate times the time period. P represents the principal or the face value of the note, R represents the annual interest rate, and T represents time in terms of 1 year. The interest rate specified on the note is an annual rate of interest, so the time factor, or T, expresses the fraction of a year that the note is outstanding. When the maturity date is stated in days, the time factor is frequently the number of days divided by 365 or 360. The time factor is the number of days out of a year, in this example, 120 days. Financial institutions use 365 days to compute interest. In this course, assume 360 days to simplify computations. When maturity date is stated in terms of months, the time factor is the number of months divided by 12. In this example, 6 divided by 12, or 50%. When the maturity date is 1 year, you simply multiply the principal or face value by the annual interest rate to obtain the interest. To illustrate, let's assume Calhoun Company signed a 1,000 2-month 8% promissory note dated May 1st to settle their open account with Wilma Company. Wilma Company makes the following entry to record the note on May 1st: a debit to notes receivable for $1,000 and a credit to accounts receivable in the same amount. The company records the note receivable at its face value. No interest revenue is reported when the note is accepted because interest accrues as time passes. If a company lends money using a note, the entry would be a debit to notes receivable and a credit to cash in the amount of the loan. Like accounts receivable, companies report short-term notes receivable at their net realizable value. Valuing short-term notes receivable is the same as valuing accounts receivable. The estimations involved in determining net realizable value and bad debt expense, as well as the related allowance, are similar. Notes may be held to their maturity date, at which time the face value or principal plus accrued interest is due. In some situations, the maker of the note defaults, and the payee must make an appropriate adjustment. In other situations, similar to accounts receivable, the holder of the note speeds up the conversion to cash by selling the receivable. A note is honored when it is paid in full at its maturity date. For each interest-bearing note, the amount due is the face value or the principal plus interest. A dishonored or defaulted note is a note that is not paid in full at maturity. If the lender expects that it will be able to collect, the two parties negotiate new terms. If there is no hope of collection, the note should be written off. To illustrate, let's assume that Wolder lends Higley $10,000 on June 1st, accepting a 5-month 9% interest note. The amount due at maturity is $10,375, which represents both the principal and the interest. The entry to record collection is a debit to cash for $10,375, a credit to notes receivable for $10,000, and a credit to interest revenue for $375. Interest is calculated by taking the principal or the face value of $10,000, multiplying that by the interest rate of 9%, and then multiplying by 5/12 because the note is only outstanding for 5 months. In this example, we assumed that no previous entries were made to accrue interest. A dishonored or defaulted note is a note that is not paid in full at maturity. A dishonored note receivable is no longer negotiable. However, the payee still has a claim against the maker for both the note and the interest. If there is no hope of collection, the note holder would write off the face value of the note by debiting allowance for doubtful accounts. No interest revenue would be recorded because collection will not occur. The accounting for the sale of notes receivable is recorded similarly to the sale of accounts receivable. These entries will be addressed in a more advanced course.